And I have Rich Sobel style. So what we want to do now is sort of pit these asset classes against each other, but some of you, like Rich, do everything. And Mr. Dukai will come on the next panel. We talk about emerging industries. We talk about AI. What's that? I can't do anything about the heat. I've tried to change the format. Seats here, where my friend Peter Thurlow would love Pulcinelli. Just maybe they haven't had this many people. I don't know, or of our ilk. But we're here to talk about what scares and excites us. I'm thinking how to do this. I'd like to maybe do a pan. Maybe Rich, you could kick off. Just think broadly with us, like because I know you've got your hands in different pies. But when you think of asset, you're also a very thoughtful person, so I'd like you to kick us off. I'm going to give you the microphone.
Thank you for the incredibly open-ended entry, Mark.
Yeah.
You can talk about anything.
Yeah.
So, just brief background. I'm Richard Nespola. I live in Washington, D.C. Been running my family holding company, Working Life Capital, for the past decade. We're an old telecom family, single-family offices, Quimby Ventures. So I've been doing this for quite a while. I think just a general kind of parlance into how we think about the world. We have a bunch of different sleeves of investments across assets. So one's real estate, one's private credit, one's venture. We also do specialty private credit for consumer brands because we like that as a strategy that's non-correlated. And then we also have an opportunistic bucket where we've done now our second SPAC. And so as we think about the world, it ebbs and flows, right? Interest rates go up, interest rates go down. Inflation goes up, inflation goes down. Certain asset classes come in vogue, certain asset classes go out of vogue. We always like to think from an investment strategy standpoint of not guessing where the puck is going to be, but always investing where the puck will always be, which is in really durable, decades-long trends. And so if you think about the transformation of AI, it's not necessarily betting on a particular AI solution. It's really more about the picks and shovels and I would say the energy dynamics of it and how you basically do clean energy to support a grid that's falling apart. So you pick apart the supply chain, you pick apart like all these different dynamics of anything you're investing in from I think like a first principles standpoint, and then really kind of look at it as like, okay, where can I extract or have a great arbitrage between risk and reward? And we just do that across various asset classes. So, I think generally speaking, our mentality has been as a family, where can we deploy capital for the next 20, 30 years? One, from a capital preservation standpoint, to get great returns for kind of a cascading family, in terms of, everyone kind of, sucking off the teat, if you will, but also being in a situation whereby we can be really thoughtful about where we're deploying our capital and things that will generate a great rate of return, right? We're not paying for beta, we're really looking for alpha. And that's in everything that we do. Is that broad enough for you, Mark, or where are you going? That's typical. So all right, I will hand this off to
Our fearless leader.
Exactly. So now I'm moderating the panel. So
Yes,
right.
yes, you're moderating the panel.
Mark. So
Keep going. You're doing a good job.
all right, sounds good. You get a water break. So that's how we thought
Suzanne
about the world.
actually covers credit generally, but she also invests across assets. Maybe go across assets and then go to your sleeve.
Sure. So, I wear two hats, right? We have a family office, really two, mine and then my father's widow, but they're separate, and obviously ages and stages, we have different goals, right? I have a minor child, she's in her 70s, so our risk tolerances are different, but we do look across all asset classes, and I think broadly our thinking in terms of being in the stay rich business is very much your thinking with a certain sleeve of what we do. My day job, which I'll get to in a minute, is sort of what I consider the get rich business, right? So in the family office, we invest mainly through funds. We don't do a lot of directs because I just don't feel like that's where my expertise lies, nor do I feel like I have the time or the nurturing or the ability to spend to make sure that I'm not going to get tripped up or stuck. I'd rather pick the best horse that's, investing in that. I mean, my dad was an early investor with Stan Druckenmiller, an early investor with Julian Robertson, an early investor with Michael Steinhardt. If you pick really good horses, and by the way, I will say we are not proponents of going with brand names. I mean, if you looked at my portfolio, 80% of the people that we're invested with, you wouldn't recognize, right? But we do think that they're the best horses doing what they do, and they're usually a little bit different, right? We've got exposure to a biotech guy who's predominantly short, right? That's something that's pretty hard to find and pretty hard to do, and he does it incredibly well. I don't think he's had a down year in the 5 or 6 years he's been in business. I did want to touch on something that's a little off topic on our panel, but that Steve brought up on the last panel. And I was at a really interesting conference earlier this week where Steve Cuneo, who did the Marvel turnaround, and he's done a lot of other turnarounds, spoke. And one of the things he said that we're really lacking in this country and that scares him the most is leadership. And that we are not teaching our children how to be leaders. And the culture that we have of everybody gets a trophy is really dangerous. And, I'm an old lady to have a 12-year-old, but, here I am. And one day she said, well, Mommy, it's not fair that everyone didn't win. I said, let me tell you something. Coming in second is only being the first loser. You hear that? The first loser. But we've created a culture, and that's why we don't have good leaders. So it's a little bit of an aside, but I think it's a really important point, particularly when you're looking to pick good asset managers. We build a portfolio that's diversified for the long term, so we're not like, now's the time for private credit, now's the time for this, now's the time for that. We don't think it's really easy to time things. It's the hardest conversation, and I'm sure you have this in a multi-generational family. My stepmother, while I love and adore her, doesn't know what a bond portfolio is, right? And so we have a macro manager in the mix, and she goes, he's not doing very well. I'm like, yeah, but how did he do last year when the other 5 guys weren't doing very well? So we want to really build a meaningfully, one of my earliest bosses in this business said, what is diversification? Well, it's only meaningful if it's meaningful. You can have 15 managers, and if they're all invested in the same thing, when correlations, go to 1, everything goes to 1. So you really have to make sure your diversifications are uncorrelated. Really understanding leverage. Right? So I'm a little broad from asset classes here, but understanding leverage in every asset class you look at and how it's used and if it's appropriate and if it's used prudently. And then in my day job, I work at a firm who, we ran a credit fund, became a family office, kept the team together because we didn't think the opportunity set was very good, and now have gone back and are raising the same fund with the same team that we ran from 99 to 2013. Lower middle market credit, special sits an event. We think small companies are going to have a lot of problems. I saw Lisa Shallett, who's the CIO of Morgan Stanley, speak a couple of weeks ago, and she said, normally in a declining interest rate environment, I'd be recommending small caps. Not this time. The only investable ones are totally private. But some of those private ones have outstanding public debt that you can invest in, and that debt's going to need to get worked out. So we think there are real cracks in the small cap market. It's the canary in the coal mine. We're concerned about the Fed's hubris around leverage. They can do whatever they want in terms of the Fed funds rate. I see the 10-year between 10 and 25 basis points on either side of where it is for the foreseeable future. So there's not going to be a lot of relief. And we've seen in the last week, right, mortgage rates went right back up. So the consumer, who actually has not done as badly in this rising rate cycle as before because the demographics are more people are living on a fixed income, the consumer hasn't been hurt as hard, but inflation is still a problem and it's here to stay. Once prices go up, they don't come down. Right? Maybe eggs will come down because not as many chickens are dying, but across the board, unlike Donald Trump, and I don't know whether he goes to the grocery store or not, but it was very nice of him to give that woman $100. But I go to the grocery store, right? And it's sticker shock. Like, I went from shopping at Whole Foods, I go to Trader Joe's, right? So I think inflation's here to stay, and I think we have to be realistic about it. So I think credit's very interesting. For the time being, I think you want to really focus on diversification. You want to focus on the best horses and niche strategies, not just the mainstream. And the big guys.
Did you tee this up for Brian? Is that planned, what you just said?
It's a whole bump set spike.
Yeah, it's a perfect softball to you.
I believe it, but I will say, and I'm going to turn it over to Brian, in private credit, and Brian's fund is structured a little bit differently than most in private credit.
To be fair, you've just met Brian, though, right?
Yeah. So I learned a little bit
Yeah, yeah.
about what he's doing, but I'm saying his fund is structured a little bit differently than most private credit funds. What I would be very, very careful of in private credit and private equity, for example, is vintage risk. Right? And I do think that there are some prior vintages that are going to have problems in the private credit world. I think you're going to see them in the secondary market. So if you're looking at secondaries, which I think is going to be very interesting, because particularly in the E&F world, the denominator effect is real. Right? These CIOs who still have to pay out 5% a year, their public book has been marked, but their private book is not, and they still have to pay out 5% on what they know isn't their really, the assets in the endowment, and it's problematic. And so you are going to see more activity in the secondary market, and you're already seeing a ton of people out there with funds in the secondary market. But in private credit in particular, and in private equity to a certain extent, you're really going to want to see, if you pick a secondary manager, you want to know that that secondary manager is really underwriting to the loan level, or if you're doing it yourself, you want to have the ability to transparency and see into what you're really doing.
All right, thank you very much. I'm Brian Walter. I started a credit asset management fund, real estate private credit. I spent about 30 years in the fixed income markets, both on the public side, the QSIP side, as well as the private side. From an asset allocation standpoint, I'll just speak to the debt side. 2 points that I would make. One, private versus public. After spending 20 years on the public side, I just think the data is very clear. That you may be able to pick a winning manager for a certain period of time, and they may have a good 5 or 7 year run, but a reversion to the mean happens. The data, certainly on equity public investing, is pretty clear that most don't outperform the S&P 500 on a consistent basis. They may for 5-year periods, but certainly not over the long haul. And I found out.
If you buy and hold, which most people don't.
Yep, and then you got to manage your emotions. So. But it's to me, I think most individual investors are underallocated to the private side of the world. Obviously, there is liquidity to consider in that transition, but certainly there is a portion of the portfolio that I think people should be a lot more invested in the private side of the world. I made that transition about 10 years ago in my career, and certainly have most of my net worth in there. The other piece, I think, which kind of pertains to psychology. I go to a lot of conferences. The debt people are usually down the end of the panel, and the venture capital and the private equity people are sort of center stage. We are in a world of instant gratification. I'm sure all our teenagers who have cell phones are only being raised to have more instant gratification, and I see that when I talk to a lot of younger people, when I pitch people who maybe are second gen, third gen family office. They want 2x, 5x, 10x. That's their focus. I'm not going to lie. When I was in my 20s and 30s, I had a lot of the same thoughts. You think you're smarter than everybody else. You think you're going to pick that next winner. And what it took me a while to realize is compounding works. Compounding works if you have a consistent, stable 10 to 12% sort of net return. You're going to double your money every 5 or 6 years. And by the time, what most 25 and 30 and 35-year-olds don't think about is when you're 55, you're going to have a nice chunk of money that you can retire with. So that would be my 2 pitches on the fixed income world.
So a different kind of asset class, if you think of it, is tax alts, which might have a timing element. And if you could pass the mic down. And Greg's with an interesting firm.
I liked your quote. It was actually Ricky Bobby's father that said, "If you're not first, you're last."
or if you.
By the way, just to add to what you said, another thing that Steve Cuneo brought up, which I thought was fascinating, was he's asked by a lot of the companies that he's either turned around or knows the managers of to interview the 20-somethings that are coming in, and he said most of them are shit. They come out of the Ivy Leagues, they come into the interview, and they say, well, in 3 years, I'm going to be a partner, and in 5 years, I'm going to be a senior partner, and in 10 years, I'm going to be managing partner, and that's just how this works. And he says, I look at them like they have 2 heads. But it's to your point of the young kids want it yesterday, and they think it's just should be given to them. And I said to my daughter yesterday, I said, you want to get straight A's this semester? Because, of course, I promised her a prize. But I said, you want to get straight A's this semester? I'd be writing my teachers and saying, I've got an 89. What do I need to do? Don't ask your mommy to do it. You have to go do it.
So who's mommy, the LP? I don't know. So, all right, Greg.
Go ahead.
You want me to tee you up a little
I'm
further?
sorry, I cut her off.
No, you teed her back up.
Yeah, I'm Greg Wilder.
I'll tee you up. So
Okay.
Exemplar is like Arthur Anderson, but smaller, different era. And you were an Anderson partner too, like I was. And we've now partnered with Exemplar. So they do tax and legal and all these other bits, and they have some really interesting things that you're going to need from time to time on ordinary income, in the U.S. at least, ordinary income and CapEx. So it's good to have a partner that you can, like control risks. You name a country, I've got intelligence. We have collectively intelligence. So we need more intelligence on the tax side. And I had a tax event. People came out of the woodwork because they're actually interested in it.
I'm going to say I've been practicing for 42 years now as a tax attorney and CPA, and I think next 3 weeks it'll be the 6th administrative election I've been through in my career, but nobody doesn't want to talk about taxes. If I ask for a show of hands, there's probably not too many people here who like paying taxes. If there are, you can go to sleep for 5 minutes. I don't really belong here. It's not an asset class, but the way...
You told me it was.
Well, I can tell you it is if you think of 20 to 50% of your annual earnings going to taxes, and most people are not happy with the return on that investment. I know I'm not, and I'm talking about federal and state, U.S. We're only talking about U.S. And I'm only going to talk today about 2024, things you can do for this year's income. We're going to have 2 more sessions, as Mark mentioned, after the election on longer-term planning, exit planning, a whole bunch of other things down the road. But what can you still do today that can knock off literally as much as half of your current year tax bill? That's pretty powerful. We're talking about big dollars. Most all of these ideas, there's 6 I can run through very quickly. Only one of them doesn't involve a private placement, Reg D private offering. It's only for accredited investors. Unfortunately, that's the way the world is. Only the wealthy can take advantage of the best tax saving opportunities. That's basically how it works. One that's still alive, despite what you hear from the IRS about them all being garbage and fraud, and we've been doing them since the 1970s, conservation easements. Well, we can't do the syndicated deals anymore that you've probably either done or been approached in the past for the last 15 years. We've been doing them, but the IRS finally convinced Congress in 2023 to legislate them away by artificially limiting the deduction to 2.5 times your investment. Well, if you do the math, a $2.50 deduction on a dollar
Let's skip
investment.
that. Let's move on.
So we don't do those, but you can still do it on a house. We did them in the 1990s for a billionaire in 1997, 26 years ago. Anybody want to guess what the most expensive home in Broward County was 27 years ago?
7.
Pretty close, 6 million. Yeah, and every week there's in the Wall Street
Well,
Journal.
tell us what we
100 million.
can do, since we can't
What you
that
can do
anymore.
is that. The other 5 are all syndicated deals. We had to come up with a replacement for that. We can no longer do that. So we're able to do the same thing with personal property in the biotech and medical space, which is an asset class. Again, it generates massive charitable deductions. For a $1 investment, you can get basically a $5 deduction. We can still do fee simple donations, which is the same kind of deduction. You're actually giving the property to a charity. You're not putting an easement on it. That's number 3. Those don't have return on investment dollars. It's money that's basically invested for saving taxes. The other 3 are things we've had to create that have both income economic returns and have great deductions. One everybody knows about, it's oil and gas. We have everybody gets 75 to 85% of their investment back in the form of tax losses over the first 2 years. But the real key there is to look for the best investment return, and that's what we focus on. The last 2 are ones we're creating and coming out with this year, which are, one, very simply, everybody's read about these tiny homes. Well, we have a client who's generating 45 million of EBITDA in his 2nd year renting these things on the man camps out in the oil fields. How do you turn that into a tax deduction? Well, they're actually personal property, believe it or not. 95 cents of every dollar invested turns into a non-passive deduction the first year, plus it returns 20+% IRR on the investment. Great investment, but it's also got some great tax advantages. So that's an example. We have another version of that coming out with RV parks, putting those on RV parks, which everybody built these high-end ones during the pandemic. They're still 40% unoccupied. Why not put these in there? There's a lot of people that want to go to a national park or a state park that is right next to a national park, but they don't have an RV. So get it up to 100% occupancy. Those are all done through syndicated private placements. So that's the overview. There's still a lot of ways to save up to half your annual taxes.
Okay, so that was a spectrum, and thank you for that. Questions? Can you scream it out? I mean, scream. Yes.
I can hear.
It's not loud, actually. You're a New Yorker. Come on.
What could be turned into, of all the things you just rattled off, which ones could you put in a vehicle that could then be sold for cents on the dollar, whatever it is, to somebody that can use it better than the person that already can take it? You rattled off a whole bunch of categories.
Well, the ones that are syndicated are ones where somebody actually has the property. So think about a biotech company that's trying to raise capital they've gotten through first phase FDA trials, let's say. They need to raise capital. Instead of raising dilutive capital, they can sell their product to these funds, have the wealthy investors put in the money on a non-dilutive basis, and the investors end up getting the tax benefits, if that's what you're talking about. So you got to have some things that are two steps where you got to find the actual product that works, or you got to find the landowner. So those are the people that benefit from these things. But the investors are funding it, but on a non-dilutive basis. Instead of raising equity through the traditional way you raise equity for a VC, you're doing it through people looking for tax deductions. Does that answer your question?
And that's something that could be transferred to someone else?
Well, you mean actually transfer the property? Yes.
Andy, by the way,
No.
there's going to be
the individual
a
investor.
tax breakout. There's going to be a tax breakout in
The
like
individual
5 minutes.
investor is the one that gets the deductions.
5 minutes tax breakout. Other questions? Zero questions about all the asset classes you can invest in? Okay, Duncan. Yell it out. I mean, yell it out. Hold on. No one can hear you. Say it again.
We got these large alternative managers that, have been running tons of money, and their real skill set is raising capital. If you go through some of the returns of endowments and state pensions, they're completely unremarkable. So my question, and it might be interesting for this group, is there's so many emerging managers that have these really interesting ideas and higher returns, but they're kind of handicapped by sort of a lack of the marketing arm, as far as I can tell. And I'm just wondering if anybody's really thought about how can that group of managers get a bigger piece of a pie. And that's my question. It's sort of a brainstorming question more than a comment.
Yeah, I think so. The whole reason why we kind of set up the family holding company and doing directs and finding co-GP opportunities to back really interesting ideas or emerging managers was we were increasingly dissatisfied but what all the platform kind of JP Morgan, Morgan Stanley, types of products or offerings were there because they were all large format, right? Because they're all fee-based. All right, they're taking a cut of everything. And so you're only seeing the biggest stuff that's going to be a fee generator for them, not necessarily within the client's best interest of making the best absolute return, which wouldn't be able to get on a platform. And so out of all of them, I think like Morgan Stanley, this is not a plug, we're not a client, but we have friends who run these strategies where they start to have like more emerging managers. They're still of size like 100 to 250 million. But it's a caveat, right? So they help raise money for smaller funds, but you're not getting those emerging first-time managers coming out. That's still, I think, the domain of people in this room, other groups like 361 or Tiger 21, et cetera, where they can get in front of an accredited investor, a family office network, where they can pitch and kind of give their perspective on why they think they're differentiated. But I'd say like that's broken for a reason, right? Because it's all fee-driven. And so I think that's a problem. I think there are, from our perspective, like one of the best funds that we invested in originally was Fund 1 from Seinwave Ventures, right? Yaniv Suissa, great GP, spun out of NEA, hung his own shingle. I mean, it's like 5.5 times DPI for us, right? First fund, we took a bet on someone who was smart and thoughtful and creative and had a good approach and was differentiated, right? And so we supported him in that effort. Even prior to that, we were like one of the first LPs in Barry Sternlicht's funds, right? So when he did Starwood, the first Starwood fund, which was a phenomenal return. So for us, it's about finding talent first and a thesis that supports that vision, firm in the vision, flexible in the details. But you're just not going to see that through where all the money making is done, right, for these large mega funds. And my last comment is, if you look at some of these structures like I think it's like a Blackstone Opportunity Fund, right? I'm not shitting on them, but I am. The fees are horrible because there are like multiple fee structures depending on how much you invest. It all comes through a platform play. And the returns are meh, right? You get a little bit of real estate, a little bit of private equity, a little bit of CLO. Like, it's across all their different offerings. But the reality is, like, everything has a tendency to regress to the mean, and you find exceptional outcomes on the fringes. And we found exceptional outcomes by backing and finding really great managers with a distinct point of view, or for us internally to start strategies that we have conviction behind, right, that we want to go long on and build for our family. That's my take.
Yeah, I just want to add, I made my wealth raising money for managers, and I've taken managers from 0 to $1 billion. I took a manager that had gone from 5.6 billion to 3.5 billion, back to almost 6 billion before we sold the firm. So this has been my world for the better part of my career. And what I would add about banks and platforms is we in my family office used an OCIO, and he ran that business within Oppenheimer, then within Bear Stearns. And when Bear Stearns went under and they had to go to JP Morgan, they went to JP Morgan, Jamie Dimon said, Jeff, we can't, your business doesn't fit within us because everything we do, we take a fee. And our OCIO, and we do seed managers from day one, but every fee rebate or every deal that he makes with a manager, I say we because I work with him quite closely. He was a big client of mine before I became a client of his, but every fee break goes straight back to the client. Whereas JP Morgan's taking a vig, and that's also a process of negative selection because not everybody wants to give that, right? So I tell people, I was just talking to a multifamily office the other day. Most of their clients are executives at big banks who don't want to invest within the bank for that very reason, because you can only get the product that JP Morgan and the 30-year-old, and with all due respect to everyone who's been in those businesses, but they know what the structural flaws are, right? You've got a 35-year-old analyst in the alternatives business at Goldman or Morgan. They're making the decisions about what the brokers can sell.
Let me ask you, that you've clicked on something, a nerve.
Sorry?
What about the consultants in this world, which are often the people on the front lines, are these 35-year-old people who never come up with an innovative set of funds for you to look at?
It's the same problem, but for a lot of the institutions, and again, this was my world for a long time, for a lot of the institutions that have to have consultants, right, because their constituencies are doctors or a teachers union, and the people sitting on the board are teachers. One of the funniest meetings of my entire career is I went to the final presentation to the retirement board of a state teachers organization. And we had been stamped by the staff and the investment people and whatever, who in this case were relatively sophisticated for a public pension. I once had the CIO of a public pension, $1 public pension, sit across from me and say, how do you physically short a bond? I was waiting for Alan Funt to come out. Where was the candid camera? Because I couldn't believe I was having this conversation. But we get up on the stage.
It's hard to fail in those jobs because you don't have to think.
Well, no, it's not only, no, they're not aligned. It is easy to fail. It's hard to fail if you only buy IBM because you don't get fired for buying IBM.
Or Goldman.
And that's why these people are not willing to be creative, right? If Apollo screws up, the board's not firing you for having hired Mark Rowan and Apollo. Their board's not firing you for having hired Steve Schwartzman and Blackstone. If you hire Suzanne Murphy, who just spun out of something, and I screw up, you're getting fired. And the next job might be 3 states away, and your kids are in high school, and your wife's now pissed off at you. It's the interest in our line. But so we're sitting on this dais presenting to this teachers board, and the guy before we went up said, you want to talk to your 5-year-old. And so my partner starts negative carry and this and that, and I see the guy from the staff's face going like this, and finally he stops us and he says, can anyone in this room tell me what carry is? Blank stares. So I went like this to my partner and I said, I got this. And then I started by, do you have a mortgage? Right? And then we got into the conversation. But that's why the consultants are only pushing things that are very mainstream.
But doesn't this play to your favor, Brian, now? Because you're now entering that.
It does and it doesn't. So it does because I live the problem you're talking about, right? So we are, the main fund we raise money for is, a $250 million fund. It's $250 million. We started it with $6 million of our own money. So I also work for an asset manager where Morgan Stanley was our banker. We sold the asset management company to Oaktree. and we started a hedge fund, we couldn't get that fund onto Morgan Stanley's platform. And we pay them millions and millions of dollars in fees over a 10-year period.
But you have the
So-
advantage from people looking at it from the outside that you have that relationship with Oaktree, which is the household name. So that's sort of the best of both worlds, and you've been in business for 6 years, which people know the business risk aspect of the business isn't there, right? Because that's always something you have to worry about with emerging managers. But I did want to finish by saying you're absolutely right. The better returns are with smaller, emerging, nichier strategies, and that's where we focus. But you really have to have the ability, which it sounds like you do, to do due diligence. And if you don't have the scale in your family office, to be able to really do that heavy lifting, you want to work with a guy like the guy I work with who has a team of analysts to do all that. I mean, yeah, and it was just
Let
before
Brian
my
finish.
father died, for
Let
example.
Brian
I
finish his thought, and then we'll
but before my father died, I said, Dad, you can't, after Madoff, I said, you've been great on the investment side, but now you can't invest until somebody's done the ODD, right? Because that's also a big issue.
And that's what's happened, right? It's post-Madoff, like you said, perverse incentives. So where we found the most success, even to get Mercer to come look at us, right? That is in and of itself a process. To get ICAP and CASE to look at us, even that we have to get to a certain level. So it's just all filtered and watered down. Where we've had the most success, quite honestly, is independent RIAs, because they, $1 to $10 billion RIAs literally pitch to their clients that you will not find, our company, Fairbridge, on Morgan Stanley's platform. And that is a value add that they're pitching to their clients. And that's why you're seeing some growth there. And quite honestly, the other place where we've had phenomenal success is in networking groups. We've talked to many of them. We've raised tens of millions of dollars through networking groups, because that's where our best referral source is our existing LPs, and that's where we have a lot of success.
So just one comment on that, and this only comes to mind because I see David Teton in the back, actually. So I think one of the things that is really difficult for emerging managers is actually going through that operational due diligence process and filling out like a 30-tab DDQ. They're good at identifying opportunities in their swim lanes of investment, right? Whether that's technology or deep tech or AI or crypto or real estate or whatever it is. They're not good at the back office shit. They're just not. And so until you get to scale and you have the ability to have, like management fees relative to your fund size, pay for all these things, it's like you're just stuck on a hamster wheel, right? And so they kind of can't get out of their own way to get to that escape velocity without some additional support. And so like you can find really great managers, a really innovative point of view who will never get platform because they don't have the time to invest in that back office, right? Or the capital to do it. So like finding people who have that domain of expertise where they can deliver that type of service, like almost like an outsourced back office for these funds, that's what I'm saying. Like that actually is a great way of actually identifying really great managers who are using those services almost as like a back end into this. And like, I think there are a bunch of different ways to attack this problem, but I think going the big bank route, like you're never gonna see people that are gonna give you that tremendous rate of return.
So wait, we're gonna move into breakouts here, but do you want a last thought, Mr. Tax Guy? You're good?
I did spend 4 years outside of my tax career in the belly of the beast at JP Morgan in the private bank, and I totally agree with you. The best alts are not there. They're not at the big institutions. I mean, besides the one you mentioned, UBS will let some smaller ones onto their platform, but getting on it's like almost impossible. Yeah. And it's like you have to sell them to even let their clients have access on the best ideas. So you're going to get it from places other than the big institutions.
The best guys, especially from limited capacity.
Yes, yes.
Are not going, and a lot of the better performing funds, right, have some sort of limit to their capacity. They're not going to give up a piece of their fees because they're only going to have so many fees at the end of the day.
So here's how we're going to break it out. This side of the room with those couches, and we're done. Is anybody on this side, because I don't have a perfect room, venture. The other side of the barbell, private credit, over here, real estate income, public markets in the back. So David, you'll lead venture over there. If emerging managers, because we created it for you and a few other people, which has sort of been the theme of this discussion, will be in the corner room, has the best view. What if you're in two sleeves? Yeah, you guys can keep moving too if you want. And then tax alts will be also in one of those rooms. If you want to go to global regions, 42nd floor, there'll be GCC, Asia, Europe, UK, and LATAM and Africa. That'll be 42nd floor. And yes, Nida, I just did it. I know you got it all mapped out, but I just sort of redid it. Venture, credit, real estate, public markets, merging managers, tax alts, regions upstairs. Here's the way it works. It's going to be messy to get in those rooms, right? Get over here into a circle. Even the tables don't even help us, and it's hot. But try to get into those rooms, and we'll have a moderator to make sure everyone introduces themselves, and then we talk about these themes. And one action point is, what do you think our community should do with respect to that venture, private credit, in terms of events, summits, or what do you guys see in the markets, and how can we help each other? Maybe it's an OCIO roundtable we need to create, whatever it is. And then in the regions upstairs. And then we're going to come back here by 4. We're going to debrief and then launch 2 more panels. The next time you do a breakout, you will have a glass of something in your hand, like wine or beer. But this time, it might be a coffee or a water or something else. So that's what we're doing. And thank you to our panelists for kicking that off. Appreciate it. Yeah, go with Duncan. Duncan Riefler. He asked that question.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.